what we've got is probably 18 months of phenomenally good returns. You could throw a dartboard blindfolded and make money. So that's great. It's one of those great times where the business cycle's going up, interest rates are coming down, liquidity is coming into the market.
Over the next, I guess, 15 months.
15, and some of these lag. Commodities will keep going up probably into 2026, mid-26, because it gets inflationary later in the cycle. So we've got a really nice period ahead of returns that we can all call ourselves geniuses, which is nice. And so
it's a crypto summer where even the shit coins do well.
Everything does well. Honestly, you can be a total moron in this market, which suits me. I'm fine. Don't forget, step back. All of the noise you read, all of the stuff. Rates are at 5.5%. Headline CPI is at 2.5%. Trueflation, which I think is built on Chainlink.
Yeah, that's right.
Is at 1%. Right, rates are 300 basis points too high. They're going to come down a lot. Everyone's going to feel a lot better. Spending's going to come back. Corporate earnings rise. Everyone's going to feel great. And the cycle will repeat. 2026, the cycle slows down again. And then we go through the same debt refi cycle all over again.
Bitcoin and the broader cryptocurrency market are poised for a major upswing, with the next 18 months expected to deliver exceptional returns. According to macroeconomic expert Raoul Pal, even those with little investing experience could see significant gains in this environment. In a presentation at Cayman Enterprise City last week, Raoul explained the forces driving this surge. He highlighted that global liquidity is on the rise, as the Federal Reserve cuts interest rates and banks all over the world start printing money. This isn't a reflection of assets becoming more valuable but rather a depreciation of fiat currencies. In such a landscape, Powell believes that the key to outperformance lies in picking the fastest horse in the race, and historically, that horse have been cryptocurrency. Make sure to watch to the end of this video where Raoul explains why, beginning from now over the next 18 months, the crypto market is about to explode upwards. Also, if you enjoy listening to crypto-related content, please show your support by liking and subscribing to this channel by following the link in my bio, and get access to my free daily crypto updates and expert predictions direct to your inbox. Each newsletter contains market intelligence, on-chain data and latest updates from experts in the crypto space. All of this is available completely free of charge. Signing up only takes a moment and you can always change your mind later on. Now back over to Raoul Pal.
What's become obvious is I talked about this theme of debasement, and there is, I call it a supermassive black hole. Right, we're all used to, many of you CFAs in the room, and we're all in the investment world, and we're used to diversified portfolios. It's kind of a weird world where none of that matters anymore. Everything's correlated to this liquidity cycle. They're either lead or lag. That's it. That's all you've got. That's the only tools you've got to play with, unless you're dealing in alts. Even most alts are actually still correlated with the business cycle, which makes it a problem for people in how to think about this world. But I have done the terrible thing of just saying, well, if it's all correlated, I just want the best risk-adjusted asset class there is. And once you actually do the work on it, bizarrely enough, it's crypto. The most volatile, the thing that falls 80% every 4 years. Every 3 years, crypto is the best performing asset class. Every single year, every single 3 years, until the year, 2 years after the US election. This is this debt refi cycle, and it's always the worst. And in the worst, it goes down 80%. Most people would say that is an uninvestable asset. How can you possibly buy something that goes down 80% every 4 years? And yet, its compound returns since 2011 are 2-point-something million %. Best performing asset class in all time ever. Its annualized returns, Bitcoin alone, is 130-something %. And that includes 4 80% drawdowns. And we can't get our heads around it, particularly as CFAs, because you're not taught to do any of this stuff. But it is completely the opposite of what you're taught. But it's an incredibly powerful thing. So the macro backdrop leads us to hyper-concentrate risk. And I didn't understand, I was too late to this everything code cycle to really understand it. But look at the richest people in the world. Who are they? Elon Musk, Larry Ellison, Bill Gates, all of them are tech people. Most of them made all of their money over the debasement of currency plus secular trend cycle. It's one trade. Why is Jeff Bezos and Elon so rich? They've never sold a single share. Well, Jeff Bezos did. He had to give his wife half. But other than that, Elon has never sold a single share apart from to buy Twitter, so he just accumulates the whole kind of ecosystem he's building. That's the same with this whole space. So, that's why, as a macro guy, I'm not the crypto kind of junkie who just believes in this thing. I've done tens of thousands of hours of work, and I've realized that it is the only asset that matters. So how I look at markets is I use a combination of the long-term secular trends, what things are trending over time, then the business cycle, and then liquidity. And I found over the years, my framework's been adapted as I've understood more and more that liquidity has become almost the total driver of returns. And then you get some excess returns for secular trends. When you break down what I mean by all of that, the business cycle, as we know, goes up and down. You can use the ISM as a way of understanding the business cycle. We're currently at the turning point of the business cycle, where on a forward basis, we should see the economy improve. So the calls of recession and stuff, that was from 2022. Right now, we should be seeing expansion on the road ahead, whilst the rates are coming lower. But what I found in my work over the years is I uncovered something that I refer to as the everything code, and which is a bit of a kind of hubristic title, but it was really shocked me. I think I was one of the first people in the world to find that what had happened back in 2008 was we had a global debt reset. As opposed to a debt jubilee where you don't pay any of the debts back, you had an interest rate jubilee. And so what happened is all of the major central banks and governments around the world agreed not to pay interest. That's what zero interest rate policy was. We kind of were sold that it was a story of we need stimulation. It was not stimulation. What it actually was a jubilee and you don't need to pay your interest rates. Why? Because all of the governments around the world have got to 100% of GDP in debt. Now, when you're 100% of GDP in debt and you have an aging population, you tend to have slow GDP. So GDP, trend rate of GDP in the US is about 1.75%. Let's call it 2% for easy maths. And let's say average interest rates over the last 10 years have been 2%. So 100% of all economic activity goes to pay the interest payments on the debt. Issue is the corporate sector is over 100% of GDP in debt. This is the only game. Everything else is irrelevant. Every single asset class, every single economy, every single central bank is all highly correlated based on this debt cycle. Why this debt cycle? Well, back in 2008, everybody reset their interest rates to zero and then restructured their debts maturities at all government level from 3 to 5 years. So you've got a 4-year cycle and it's perfect. It's also exactly what happened in the 1950s after World War II, because we had the same issue then and we did the same thing then. And as opposed to zero interest rates, what we used then was yield curve control. So, okay, we understand that. But what they're doing is every time the debts come due, which is this year and next year, we've got 10 or 11 trillion in the US alone of debt to roll over. They print money in the form of liquidity. It's not just the balance sheets. Every aspect of liquidity you can find in the system, they understand the game. They all do it together. And they're doing it now. So liquidity is the driver. So when you start adjusting markets, this is the magical thing. Once you adjust the S&P 500 by Fed net liquidity, the largest measure of liquidity in the US, the S&P 500 has gone nowhere since 2008 and 9. Because it fell in 2008, it's gone nowhere. Almost zero returns in real terms. Gold, same. Real estate is different because you use leverage, but if you would use unlevered real estate, it's gone nowhere. In fact, no assets have gone anywhere except 2. There's only 2 assets in the world that outperform debasement of currency. Debasement is the excessive printing of currency to pay your own debts, using a credit card to pay a credit card, for example. only technology and it's only crypto. And then when you look at the two, you've got crypto, technology, the NASDAQ does 17% a year. The basement of currency, by the way, is about 7% a year. No, sorry, 8% a year. 8% a year plus the rate of inflation. You're talking about 12% hurdle rate, something like that. What you're finding is the S&P 500 does 12%. Zero. You're making no money. You own that, you don't get any wealth generation. NASDAQ does 17%, so you are. It compounds over time. Bitcoin, which is the worst performing of the major crypto, is doing about 130 something percent, depending when you measure it. We've never had an asset class like it. Okay, so that's the general framework. So where we are today? Well, liquidity, being the main driver, leads the business cycle. It bottomed in exactly the same time the NASDAQ and crypto bottomed, which was October, November, December 2022. And it's been going up, and those markets have gone up. And they lead because they follow liquidity. Most other instruments, the Russell 2000, oil prices, copper, they tend to be living in present day business cycle, which is today, which is just picking up. So you're starting to see commodities still rock bottom, starting to pick up. You're starting to see Russell 2000, you're starting to see the equally weighted S&P now all-time highs. You're starting to see that happening. So in terms of markets, what we've got is probably 18 months of phenomenally good returns. You can throw a dartboard blindfolded and make money. So that's great. It's one of those great times where the business cycle's going up, interest rates are coming down, liquidity's coming into the market.
Over the next, I guess, 15 months.
15, and some of these lag, commodities will keep going up probably into 2026, mid-26, because it gets inflationary later in the cycle.
Yeah.
So we've got a really nice period ahead of returns that we can all call ourselves geniuses, which is nice. And so
it's a crypto summer where even the shed coins did well.
Everything does well. Honestly, you can be a total moron in this market, which suits me. I'm fine.
Which is perfect for everybody.
Yeah, that's right. So that's where we are today. So it's we're coming into the easy environment. Tomorrow the Fed will cut 50, 25, whatever. It doesn't matter. Don't forget, step back. All of the noise you read, all of the stuff. Rates are at 5.5%. Headline CPI is at 2.5%. Trueflation, which I think is built on Chainlink.
Yeah, that's right.
Is at 1%. Right, rates are 300 basis points too high. They're going to come down a lot. Everyone's going to feel a lot better. Spending's going to come back. Corporate earnings rise. Everyone's going to feel great. And the cycle will repeat. 2026, the cycle slows down again. And then we go through the same debt refi cycle all over again.
Thanks for watching. Please don't forget to subscribe for news and expert predictions direct to your inbox.